I'm Jeff Lamb, President of Wealth Distribution Strategies. I'm going to talk to you about our quarter three market commentary and updates for 2025. As a reminder, with this video, this is meant for informational purposes only. It should not be construed as investment advice. References to specific portfolios should not be considered a recommendation. Data and analysis does not represent the expected future performance of any investment product or strategy. Investments involve risks, including possible loss of principal. As a reminder, feel free to talk about this with your advisor at your next meeting. So 2025, we jumped into the year with a lot of uncertainty and therefore markets became very volatile. In fact, the volatility index reached above 30 for just the 32nd time since 1990. Now, historically, when we've seen periods of high volatility when the index reaches above 30, this has occurred 31 previous times. 28 of those 31 times, the markets had positive returns over the next 12 months. In fact, by this chart, you'll see the average of those 28 times. We saw that the markets, when we talk about the markets, we're referring to the S&P 500 in this example, averaged 24.9%, where the average annual return since 1990 in the S&P 500 was just 10.6%. So when we get these dips in the market, it's never fun when it occurs. It happens for many different reasons, but it's important to remember how math actually works. And so when we look at this chart here, a lot of people think if you had a $100 investment and you lost 50% and then you made 50%, you might be back to even. But in fact, you're far from it. So let's just look at that example. You have $100, you lose 50% of the value of that investment, you're at $50. If you make 50% on your $50, that's only $25. You're only back to $75. So if you have a 10% decline in your portfolio, hopefully we don't see any 50% type of declines, but it's very possible in volatile times that we could see a dip around 10, 15, or even 20%. If you have a 10% decline and to get back to even, we would need 11.1%. If you have a 20% decline, we actually need 25% from there to get back to even. So how can we take advantage of this math? Well, something that our advisors do for their clients, and this is guided by our investment policy subcommittee, which is led by Manjula, our CFA that we have on staff, our lead financial strategist. We identify time periods to rebalance. So when you rebalance, ultimately, we're usually taking money out of things that made more than other areas, and we're adding back into areas that maybe didn't perform as well. And so when we look at our portfolios, most of the money that we manage for clients is held in our Schwab advisory accounts. Now, most clients have some similar positions with other clients, but most of our clients have a customized portfolio. But we do have a number of core positions that we use with many of our clients. And so we just wanted to share with you how we took advantage of the volatility that we experienced this year. So within the portfolios, like I said, we have a number of core positions. Now, our investment policy subcommittee that meets on a monthly basis, talks on a much more frequent basis than that, has a very rules-based approach to how we invest your money. So number one rule to investing, in our opinion, is to take your emotions out of it, which is a very hard rule to follow, especially when we're seeing our account balances fall. But we set both upside and downside targets based on a certain indicator that our team follows. And when that hits those upside or downside targets, that's what triggers a rebalance. Now, we do also rebalance portfolios in general about every 90 to 120 days if we don't hit any of those bands. We did our first rebalance of this year in late January, and we were scheduled to do our second rebalance in late April. Well, with the volatility in the market, our downside band indicator actually triggered on Thursday, April 3rd. Our committee met on Friday, April 4th, and made the decision with all the volatility in the markets to wait till Monday, just in case there was some significant events occurring over the weekend. Well, we kind of lucked out. April 7th happened to be the absolute low that we have experienced so far as of me recording this on Friday, July 18th. And so we did a rebalance. And so we just wanted to show you some of the core positions that we're using, not with all, but with many of our clients' portfolios. Now realize this performance I'm going to show you does not take into consideration other factors that could impact returns, such as any withdrawals or additions that you may have had in your portfolio at any of these different time periods, the advisory fees that we have, the underlying expenses of the fund. These are gross performance numbers. So I am showing you the different categories that we have here. And what you'll notice, most of those stock positions had some pretty significant declines. All of them but our emerging markets fund was down double digits from the first trading day of the year, which was January 2nd, through Friday, April 4th close. Now, performance, we did not capture the exact open on April 7th. The advisors placed their trades that morning, depending on their schedule. Could have been earlier or later in the morning, which would impact this performance number slightly. And so that's where I do encourage you to talk to your advisor at your next meeting and get your exact performance numbers. But we took money from our two bond positions that are here at the bottom, CGCP and Yukon, and much of that money was distributed back into some of these equity or these stock pieces in the portfolio. And when you look at the performance 1 month from doing that rebalance from the open on April 7th through the close on May 6th, you'll see every one of those stock pieces had double-digit returns. And then if we look at a 3 month performance time period, we see even larger returns in the portfolio. So when we did the rebalance, we actually were buying back into many areas of the stock side of the portfolio, and we were taking money from the bond side that wasn't down at that point in time. Now, when we talk about this rebalancing, when we hit a downside threshold, we actually don't just do a regular rebalance, we actually increase our equities in the portfolio. So we're adding more fuel to the fire. So when we go back to its math chart right here, if we had something that was down 20% and now has gotten back to even, with that new additional money we added into the portfolio, we were actually up, in a hypothetical example here, 25% if it rose 20%. So we want to use math in our favor. We want to add when markets are down. And I know the average investor, when markets are going down, they're saying we should sell. We should get out of these pieces. For example, like our Invesco QQQ, it was down 17.2%. Well, over the 3 months to follow, it was up over 30%. Now, we also will make changes to the portfolio from time to time, and you'll see here, CAF was the ticker symbol of our small cap fund. Small caps have not performed nearly as well as larger company stocks have this year or over the last several years. And this was a fund that was on our closely watched list, and we decided to make a fund swap. So we didn't change our allocation necessarily to small caps, but we said we are going to utilize a different small cap fund manager. And so that's why I don't have performance of CAF over the next 1 month and 3 months, or the performance of SDVY from January 2nd through Friday, April 4th close. But this allocation that we had in CAF, ultimately, most of that money was moved into SDVY. So there's a lot of factors that impact performance. This is just for illustrative purposes only. This is gross performance before fees, depending on account size. There's lots of things that can impact the exact performance numbers, but this gives you a general ballpark idea of how we were able to take advantage of that volatility. And as we sit here today on Friday, July 18th, as I'm recording this video, earlier today, S&P 500 hit a fresh new all-time high. We're back in late March, early April. It sure seemed like it would be a long time before we would see that, but it turned out to be a relatively short time period. So throughout history, we've seen many different crisis events, things that have created a lot of volatility in the markets. And so this chart shows a $10,000 investment in the S&P 500 on the beginning of 1970 through the second quarter of this year. And it highlights a number of different events that created a lot of volatility. Now, when you look at short-term time periods, you'll see, for instance, in here with the financial crisis, that was a big decline. It was not fun during that time period at all. But markets are very resilient. We've never not seen the S&P 500 bounce back, sometimes quicker than others, but the market is very, very resilient. And so we want to have confidence and faith that ultimately markets will go up and down, but they do go up more than they go down over the long term. This chart is actually fairly steady upward, but when you zoom into certain time periods, you see a lot of volatility with it. So First Trust has done this chart, which I like a lot. This looks at the S&P 500 index since 1937. And if you picked any single day since 1937 through June 30th of this year, um, 53.4% of those days had positive returns. So just a little bit better than flipping a coin. Heads or tails, are we going to have a positive return? If we give ourselves a 1 year time period, 77.5% of the time we've seen a positive return. So pick any day, go out 1 year, 77.5% of the time we see a positive return. Pick any day, go out 5 years, over 90% of the time we're positive. And pick any day and go out 10 years, over 97% of the time we've seen positive returns. So it's very, very important to keep a long-term perspective to what's going on in the markets with your portfolio. This is why when you're working with your advisor, we have discussions about your income needs. Very rarely does an individual need their entire portfolio this year, this week, this month, whatever it may be. We need some of that money maybe in the short term, but we don't need all of that money right now. And so our job as your advisor is to always make sure there are some smart places to access money within the portfolio, because we never know when volatility is going to hit. And sometimes it seems like a no-brainer that markets just have to go down, but markets don't always perform like we expect. So I encourage you to have the conversation with your advisor at your next STAR meeting. We call them strategy and tactical adjustment recommendation meetings. This is where we look at things that we can help improve. We can't fix anything that's already happened, but we can ultimately look at ways we can help you with your portfolio and your situation moving forward. So I want to thank you for your patience and your faith with us. Hopefully, this will give you a little sigh of relief. The markets are doing much better right now, but it's not a matter of if, it's just when we'll see another time period of volatility. I do want to get you up to date on some of the things that we have happening yet this year. And so if you go to our website, we have our events page. And if you click on the client events, you can see we do have a couple upcoming events. So our August event, we have a tax planning webinar with our lead tax advisor, Luke Wendt. And this one I think will be especially interesting because you may have seen recently the passing of the BBB bill, which the Big Beautiful Bill has a lot of changes to the tax code. And some of those changes are already taking effect this year. So Luke will walk you through a lot of those changes, talk about maybe some strategies on things that we should consider. So much of our second half of the year review meetings or STAR meetings with our clients will be focused on any year-end tax planning that needs to be done. On September 25th, we have a representative from the Social Security Administration talking about Social Security planning in retirement. In October, we will also be doing our annual pumpkin carving and decorating contest. So feel free to submit once we send the emails out, and you decorate or carve those pumpkins with your family, your kids, your grandkids. This is a family event. It's just supposed to be something fun. And we do have some prizes for some of the best decorated or carved pumpkins. In November, we will be doing another supply drive and then Next Generation Investor Series. So we have a lot of exciting events planned for the remainder of this year. And so we are excited to see you in the near future. We hope you're enjoying your summer. I'm sure the white stuff will be hitting the ground before we all want it to. So take care. We will talk to you in the near future.